Imagine you owe someone a huge amount of money. That's uncomfortable, but it's manageable, as long as the payments stay small enough to live with.
Now imagine something changes. You still owe the same amount, but suddenly, just keeping up with it costs more every single month. Not because you borrowed more, because the price of carrying what you already owed went up. That's not a hypothetical. That's happening right now, at the scale of an entire country. The borrower isn't a person, it's the government of the United States. And this year, it will pay out roughly $2.8 billion every single day, just in interest. Not loan payments, not new spending. Interest. The cost of owing money it already owes.
Most people, when they hear about America's debt, think the scary number is the total. $38 trillion, $40 trillion, whatever headline you saw last. But that number, by itself, doesn't tell you much. The real story, the one almost nobody explains clearly, is what it costs to carry that debt, and what happens when that cost keeps climbing faster than almost everything else in the budget. Welcome to the Reserve Code. Today, we're going past the headline debt number and into the part of America's financial story that quietly shapes tax bills, government programs, and interest rates for everyone, even people who've never bought a government bond in their life. Let's start from the beginning. Why does the government borrow at all?
Picture a household that earns $5,000 a month, but spends $6,000. That household has a $1,000 gap. To cover it, without cutting spending, they borrow the difference. The US government works the same way, just at a scale that's hard to picture. Each year, it collects money through taxes and other revenue. Each year, it spends more than it collects. That yearly gap has a name: the deficit. Revenue minus spending equals the deficit. And when you run a deficit, you have to fill it somehow. The government fills it by borrowing. Every year of borrowing adds to a running total, and that running total is the national debt. Deficit leads to borrowing. Borrowing adds up into debt. That's the whole chain. Nothing mysterious yet.
So how does the government actually borrow? It doesn't walk into a bank. It issues something called a Treasury security. Think of it as a formal IOU. An investor hands the government money now. In exchange, the government promises to pay that money back later, plus interest along the way. Who buys these IOUs? All kinds of players. Banks, pension funds, mutual funds, insurance companies, everyday investors, and foreign governments and central banks. They buy them because US Treasury securities are considered one of the safest, most reliable places in the world to park money. The US has never failed to pay bondholders back. That reliability is exactly why people are willing to lend it money in the first place. Here's the twist most people miss. The size of the debt is not the whole story. The cost of that debt is. Say you borrow $100,000 at 2% interest. Now imagine borrowing that same $100,000 at 6% instead. The amount you owe is identical, but what it costs you every year to carry it is completely different. Same debt, very different burden. That difference between the size of a debt and the cost of carrying it is exactly what's happening to the US government right now. And it's the part of this story that rarely makes headlines. Now let's talk about refinancing, because this is where it gets interesting.
Treasury securities don't last forever. Some mature in a few weeks, others take 30 years. When an old one comes due, the government still owes that money, so it issues new debt to replace it and keep operating. Think of it like a loan that comes up for renewal. You still owe the balance. You take out a new loan to cover it. If interest rates have gone up since you took out the original loan, your new loan costs more to carry, even though you didn't borrow a single extra dollar. That's essentially what's happening across the US government's massive portfolio of debt. As older, cheaper debt from years ago matures, it gets replaced by new debt issued at today's higher rates. The total amount owed might grow only gradually, but the average cost of carrying it can climb much faster. And that brings us to the number that matters most: interest costs.
In the most recent fiscal year, the U.S. government paid $970 billion in net interest on its debt. This year, the Congressional Budget Office projects that number will cross a new threshold entirely, passing $1 trillion. $1 trillion is almost impossible to picture. So picture it this way. It's roughly $2.8 billion leaving the Treasury every single day, without pause, without a weekend off, just to service debt that's already been borrowed. And this isn't a one-year spike. Looking at the next decade, the CBO projects the U.S. will pay out over $16 trillion in cumulative interest costs, with the annual bill climbing from around $1 trillion now to roughly $2.1 trillion by the mid-2030s. These are projections, not certainties. They depend on future interest rates, future spending, and future law. But the direction they point in is consistent and hard to ignore.
Here's a simplified way to see why this happens. Imagine $1 trillion of debt at a 2% interest rate. That's $20 billion a year in interest. Now imagine that same $1 trillion at a 5% rate instead. That's $50 billion a year, more than double, without borrowing a single extra cent. This is obviously a simplified illustration, not the actual math behind the U.S. debt portfolio, which is far more complex, blending millions of individual securities issued at different times and different rates. But it captures the core idea. When debt grows and the average interest rate on that debt rises at the same time, the cost of carrying it doesn't just add, it compounds. In fact, CBO's own projections attribute the coming surge in interest costs to exactly this combination: debt held by the public growing sharply, alongside a rising average interest rate, pushing total interest costs up even faster than the debt itself.
So, who actually pays this bill? There's no single villain here, and no single victim either. There's no envelope that shows up in one person's mailbox marked "your share of the interest." Instead, the government pays interest to whoever holds its debt: investors, institutions, foreign governments, using money that flows in mainly through taxes. Which means every dollar spent on interest is a dollar that came from the same pool of revenue that could have gone towards something else: infrastructure, healthcare, defense, tax relief, reducing future borrowing. Economists call this an opportunity cost. It's not that the money vanishes, it's that its future no longer includes the other things it could have done. And as interest eats up a larger slice of that revenue pie, the room left for everything else quietly gets smaller.
To put that in perspective, interest payments now equal about 18.5% of all federal revenue collected, already higher than any point since the early 1990s. Under current projections, that could climb to roughly a quarter of all federal revenue by the mid-2030s. 1 out of every 4 tax dollars simply going toward interest. Not roads, not schools, not defense, just the cost of debt already owed. There's a bigger ripple effect too, something economists call crowding out. Picture a limited pool of savings available for borrowing, shared by governments, businesses, and households alike. When the government borrows heavily from that same pool, it can increase competition for financing. And under certain economic conditions, that competition can push borrowing costs higher for everyone else too. A business loan, a mortgage, a car payment.
This isn't automatic, and it doesn't happen the same way in every economic environment. It depends on monetary policy, savings levels, and investment demand at the time. But it's a real channel through which government borrowing can ripple outward into the wider economy. Now, some important context, because this isn't a doom story. The US is not an ordinary household. It borrows in its own currency, has an enormous capacity to raise revenue through taxation, runs the largest economy on Earth,
and benefits from the dollar's central role in global finance. Its debt markets are the deepest and most liquid in the world. That combination gives the US financial flexibility that an average borrower simply doesn't have. Having a large debt does not automatically mean a collapse is coming.
But flexibility is not the same as being free of consequences. The real question isn't whether debt is inherently dangerous. It's whether debt and interest costs stay manageable relative to the size of the economy and the revenue coming in. Right now, interest costs are already larger than what the government spends on national defense or Medicaid, and are on track to rival and eventually exceed spending on Medicare, one of the largest programs in the entire federal budget. So zoom out. What happens if this trend continues? Less room in future budgets, more pressure to either raise revenue or cut spending elsewhere, greater borrowing needs to cover both the deficit and the rising interest on debt already owed, possibly higher borrowing costs rippling into the wider economy, and growing political pressure over what the government can still afford to do. None of this guarantees a crisis, but it does describe a long-term fiscal challenge that doesn't resolve itself. It either gets addressed or it keeps compounding.
Let's bring it all together. The national debt is the total balance owed. The deficit is the yearly gap between spending and revenue that adds to that balance. Treasury securities are how the government borrows to cover that gap, and interest is the price of carrying everything that's already been borrowed, a price that taxpayers ultimately fund, one way or another, through the revenue that flows into the federal government. So who pays the interest? Not one person, not one group with a name. It becomes part of the government's ongoing financial burden, one that plays out through future taxes, future spending choices, and the pace of economic growth in the years ahead. The next time you see a headline about America's debt hitting another record, don't just ask how much America owes. Ask how much it costs to owe it. This is the Reserve Code.
If this video helped the number make a little more sense, hit like, subscribe for more of these breakdowns, and drop a comment. What part of this surprised you the most? Sharing this with someone who's ever asked, how does the government even pay for anything, helps this channel grow. Thank you for watching. Take care. Bye. I'll see you in the next one.